Good morning or good afternoon, and welcome to the first BetaShares webinar 2022. I'm delighted that you joined us today as we talk about the market dip, everything you need to know. Certainly 2022 is off to a shaky start. Since a year, equities have had a pretty rough ride with declines across the board. So I'll be speaking with my colleague Alistair today. We'll be running a little bit of a Q. We're taking you through some slides that should be of interest, and hopefully just putting some clarity around what's happening in the market. So before we get started today, I'd just like to run you through some important as is usual in these webinars. Everything that we are talking about is general in nature and is not specific advice. Any performance is not indicative of future performance, and as usual, if you are wanting to make an investment decision, you should talk to a financial professional and visit our website for the product disclosure statement and the target market determinations. Before we start, just confirming that a recording option will be sent to everyone who registered for today's webinar. And throughout the session, if you have any questions that you would like Alistair to answer at the end, please just drop it into the right-hand side. There should be a little question mark widget. So open that and type your questions, and we'll try to get through as many as we can. I do apologize for the audio. We'll just try and fix that. So please ask your questions and we will answer as many as. As I said, Alistair is joining me today.
Hello everyone, nice to be here.
We might actually, just to fix the audio, because I know he's traveling and it doesn't sound great, I might just pop us on pause and try and fix that, and I will be back in just a minute. Yep. Hello, thank you for joining us. Thank you for your patience. I do hope that the audio has fixed and you're not getting a bad echo. Do apologise for that. Certainly our first webinar of the year. Just a few teething issues. As I said, Alistair, welcome.
Thank you very much. It's nice to be here now that we've got all the technical difficulties out of the way.
I hope so. I hope so. So if we can just jump to the next slide. Just a little bit about BetaShares for those of you who may not be familiar. We're very proud to have the broadest range of funds, 67. We actually launched a bond fund yesterday. We have 23 billion in assets under management, and obviously, you know, our Australian born and bred, And our objective from the start and remains is to provide intelligent investment solutions that meet your needs, Australian investors' financial objectives. So we're very proud and obviously very focused on what we're doing here. So let's just jump into today's webinar. And I think as I mentioned at the start, there's obviously a lot that's been going on the last 6 weeks of 2022. So Alistair, if you could just a bit of an overview on what's been happening.
Sure thing. Yeah, you're not wrong when you mentioned before that we've been off to a tumultuous start at the beginning of the year. It's been a very volatile period, and just to give you some numbers from the beginning. So equity markets pretty much across the board have been down so far this year, and areas that have been hit hardest are probably technology. This chart just goes to show you, so these are 3 example markets. So we've got the NASDAQ 100, which is quite technology heavy, the ASX 200, which is the Australian market we'd all be very familiar with, and then the MSCI World, which is around 1,500 stocks across the globe of developed markets. And you can see there from their highs at the beginning of the year or towards the beginning of the year, they've seen significant drawdowns. The NASDAQ 100 falling as much as almost 14%, has since had a bit of a recovery and then dropped again. So that's that volatility we mentioned. The ASX 200 down just shy of 10%. And then, like I said, a really diversified index of the largest companies across the globe, down almost 8% from its highs. That's how big the fall was. So look, when you have these sorts of falls, it's natural for investors to have concerns, wondering what's going on, questioning their portfolio strategy. So hopefully the idea of this webinar is just to give people a few ideas as to how they can be thinking about portfolios, what's going on at the moment, and how can they ensure that they've got a robust portfolio going forward. Before we'll jump into a few investment ideas for the upcoming year and beyond as well.
And some of those figures are quite scary, and I think that 13.8% particularly, is it around 10% they say is correction?
Yeah, around that 10% you start getting into correction territory. And look, I mean, they're not uncommon. They happen quite frequently, and they happen for different reasons.
So what do you think, what's behind this recent volatility or these recent pullbacks, if you like?
You've had a few reasons. It's a bit of an amalgamation of different things. One, you've got a bit of geopolitical risk out there at the moment with Russia and Ukraine. That can always put a bit of stress on markets. It's earnings season in the US at the moment, and earnings have been mixed across stocks. You'd have seen Meta or Facebook has missed quite heavily, but then Amazon shot the lights out. So quite a big disparity between stocks, and ones that have been missing earnings estimates have been punished quite heavily. But one of the key features at the moment is inflation, and the fears of inflation coming through, persisting for longer and being higher than previously expected. This has been, obviously we've had COVID, and that's caused some quite substantial supply side shortages, and also labour markets have been quite tight. So all of this puts upward pressure on prices, particularly commodities have been, the price of oil has been rising very strongly at the moment.
Yeah.
And what this does in turn is central banks such as the US Federal Reserve or the RBA, the European Central Bank, the Bank of England, all of these central banks have to start thinking about rising interest rates to try and bring that inflation back under control.
But I mean, these declines when interest rates are going up are not unusual, are they?
No, that's right. And this chart goes to show this is the US market, and in the orange line you can see those falls in equity markets. So the left hand side shows you how much the market fell from its peak. So in the middle of that chart, you've got the global financial crisis and dropping.
That thick red line, the thick grey one.
That thick grey line, so 2/3 across to the right hand side of the page, and you can see how much the market's fallen. The black line doesn't have an axis, but that is the US cash rate effectively, and a lot of the time you can see that as that rate ticks up, it precedes equity markets falling, and that can be through central bank policy mistakes if they're rising too quickly and the underlying economic environment isn't favorable, but typically it's towards the end of that cycle and can cause some market drawdowns.
Okay.
And the reason for that is higher interest rates tend to shift the relative attractiveness of different asset classes. So cash becomes more attractive, or less risky investments become more attractive than equities. So you can see a bit of a rotation out of particularly growth stocks into safer, more defensive assets. So if you're being paid, 8%, this is very historically, but if you're being paid 8% on your cash, you're less likely to invest in equity markets. More recently, we've had very low cash rates. But also what you have is when you rise interest rates, it tends to slow economic growth as well, and in turn can slow earnings growth of those companies, and therefore that can have negative impacts on equity markets as well.
And you mentioned that it can affect growth stocks particularly. And would you say that the NASDAQ would be classified as that?
Yes, and that is why those technology stocks and the NASDAQ, compared to some of the more traditional areas of the market, say energy companies or banks, have been hit slightly more because more of their earnings are expected to be longer in the future, and therefore higher interest rates can discount the relative attractiveness of those future earnings compared to companies which are making more cash here and now. So that's why you've seen those technology and growth areas of the market suffer more than others.
The next slide is actually quite good, and I think it for some people who may not be as seasoned in the market, like myself, and seeing recent volatility and recent declines, this chart is great at demonstrating that, look, over the long term, that really is nicely trending upwards, but it has had a few sort of speed bumps there and a few rocky points that you've sort of indicated on that line.
Absolutely, it really helps if you zoom out, and we've mentioned this in previous webinars, but the longer your investment time frame, the more risk you can digest, and I'll go into that a bit more later. But this goes to highlight, so over the past 20 or so years, yes, that line has trended upwards, but you have had some quite significant drawdowns. So you might have concerns of volatility at the moment, but they're definitely not uncommon. A few examples here. So, and many of these were caused by rising interest rates happening quickly. Prior to the global financial crisis, you had that, and markets fell 50% that with the collapse of the financial system. The European debt crisis as well was countries like Greece unable to service their sovereign debts. In Q4, we had a similar, the US started rising rates and markets dropped by around 13% here. And then you've got things like a pandemic, which just goes to show it's incredibly difficult to predict why these things are going to happen, because they can happen for a lot of different reasons. But the common theme is that when they do happen, you get increased volatility and asset prices drop quite substantially. And it can be very difficult to predict what's going to cause these and when they're going to happen. But you can also miss out on significant sort of market growth over the long term if you're constantly worried about the next market drawdown. So looking on the long term, it helps to put this into context and learn from some of those lessons from history.
which is always great in hindsight. And it is nice to look back and certainly if you were invested in the global financial crisis and lost, you know, most of your portfolio, you're in a nice position now. But can you talk us through what actually happens to an investor? So this is happening in the markets, but what sort of behavior or what sort of emotion is likely to be happening with investors? Because I can tell you there's a bit of anxiety at the moment, and you know, I definitely read the papers and have the long-term view, but anxiety is definitely a factor.
Absolutely, and we all go through it. There is a roller coaster of emotions that happen. You know, when things are going well and everything's going up, it's very easy to feel like an investing legend, like out there. But if you are investing for the long term, you will inevitably encounter periods where things aren't going so well, and when volatility is higher, and like the beginning of this year. And we've seen lots of new investors come to market in the last 6 to 12 months, straight into periods of high volatility. And you will often see, and it's natural to feel panic and not know what to do. But this like outlines quite nicely, I think, the actual cycle of emotions as things are going well into things that are going not so well. What you do find is that typically when you feel most comfortable, that is the point where there's maximum risk. And when you feel the most despair, that's when there sometimes are the biggest opportunities over the side.
How do you avoid going straight from anxiety, denial, fear, depression, and like straight down that slope? How do you actually stop yourself doing that?
It's one of these things, like anything. It comes from experience and training. Think of yourself like just like anyone that's going into high stress situations. The more experience you have and the more training you've got, the less emotion you can put into making these decisions. So don't get too beat up on yourself if you're looking at the value of your portfolio plummet for periods of time and it is causing some stress. And it's extremely difficult without hindsight. It's extremely difficult to know where exactly we are in the cycle, even knowing where your emotions sit. And you'll constantly be doubting, is this the bottom? Is this the bottom? But there are some things you can do to help try and take that emotion out of it and think about what decisions can be made.
Okay, so if we're taking the emotion out of it and we're you know, being a long-term investor, what do you do then?
I mean, even like before that, there are actually only 3 real things you can actually do. And the first is you could sell. It doesn't have to be everything, but it could be some of your portfolio to try and avoid further losses. Conversely, you could try and buy the dips, see it as an opportunity. Every time the market falls, you can think, I can buy this for cheaper now. Or you could just do nothing and ride it out over the long term. And like I mentioned, without hindsight, knowing exactly which of these to do and which one's your best option is extremely difficult. The first 2 actually require you to time the market, and timing markets is you don't just have to do it once, you've got to do it twice. And it is next to impossible to do this consistently well over a long period of time. It requires either incredible skill or a lot of luck. So thinking over the long term can be a more sensible way for a lot of investors, not necessarily all.
And we did have a question prior to the webinar that stated, I'm an individual investor and I have a really limited amount of time to research and actually do my trading. How do I prioritize what we need to know or what I need to research? And I think that the first 2 points there about timing the market, it probably answers that question a little bit. in terms of where do they focus their energy?
That's it. Like I said, I mean, actually trying to time markets is likely to cause more stress than anything else, because you've got to be watching things all the time. Not everyone's got that amount of time to spend looking at their portfolio, making tweaks all the time, and others just don't have the interest in it. You're just looking to build up a savings pool, contribute over time. So you can be as active or as passive with your portfolio as you wish. And again, a bit like later, I can go through a few examples of how you can think in the long term. But yeah, it comes down to you deciding how much time you want to spend on it. And look, there are a lot of things out there, and ETFs have made it extremely easy for you to build a portfolio that's robust and quite low touch.
Yeah, and so if we're keeping a level head, what are some of those questions that you want to just keep asking yourself during like these periods of volatility and drawdown?
Yeah, so if you are going through that emotional cycle, there are a couple of things you can do just to maintain that sense of level-headedness. Try to take a bit of emotion out of it, and there are two easy questions you should ask yourself every time, and it's, is this pullback normal? Like I mentioned, like I showed on that chart of the Australian market previously, is these pullbacks happen for different reasons, but is it like many we've seen throughout history? And are my financial objectives the same now, and my goals, are they the same now than they were prior to this? And look, if the answers to these are no, then you may want to make some sort of sizable changes to your portfolio and make it match to your risk return appetite. But the more likely scenario is that the answers to these are yes. And like I said, that's not for everyone, but it's likely that you see this pullback and this volatility, and it happens for different reasons, but has happened over the long term. And your financial objectives have stayed the same, and therefore, rather than making wholesale and drastic changes to your portfolio, you may be better off making some smaller tweaks, if any, for the long term, and that might be more appropriate for you.
We mentioned just in preparing for this webinar, I did question what normal pullbacks look like. You referenced the chart of the ASX Total Return Index, and those drawdowns were all for different reasons. So you've got the global financial crisis, you've got the European debt crisis, the China stock market crash and COVID crash. So it's not that they've all been for different reasons. So what does normal?
Yeah, look, it's a fair question. I don't think any of them at the time feel normal. What I mean by normal is it a normal part of your investment journey? Because you just cannot expect these things to go up in a straight line. And the more risk you take, equities are riskier than cash, and the more risk you take, or the more return you expect, there does tend to be a trade-off with your risk.
Yeah, and this is what I love. We do talk about this quite a lot, but ETFs really allow you to build those robust portfolios. And I know we're going to talk a little bit about what building a robust portfolio means, and a little bit about that risk and return trade-off. We can't all go to cash where it's completely guaranteed and you get a nice income. So what are those options and trade-off, and how do you actually build a robust portfolio? What do you mean by that?
Yeah, like I mean, there is a trade-off between risk and return. Cash over the long term, is stable, but is not going to give you over the long term. There may be periods where it does perform higher or protect you, but over the long term, cash will be the safest option, and therefore you'd expect to be compensated the least for it. And then as you move up that risk spectrum through defensive assets such as bonds into property and equities, you would expect to be compensated more as the risk you're taking on, whether that's for of solvency or whether it's just general volatility, you would expect to be compensated more for that risk over the long term. So knowing your risk appetite or risk tolerance is crucial to when you're constructing a portfolio and should determine your mix of asset classes. The more risk you're willing to take, the more return you're seeking and the longer your investment time frame, the more risk you might be able to manage or weather. Whereas if you're less risk averse or more risk averse, you'd be looking more at say cash and defensive assets.
Yep, and most importantly, and I know that you've got that risk and return trade-off that we talk about, but if you are, and most of us are, I think that's probably why we're on the webinar at BetaShares. But if you are invested in equities, what's one of the most important things that you need to include in your portfolio?
I mean, diversification is absolutely crucial across all things. And look, typically markets do recover, and we've seen that, but individual stocks or individual securities may not. A single ETF can give you access to hundreds, if not thousands, of securities in one trade. But it's also important to consider a blend of regions and sectors, as well as different asset classes through your portfolio, because not all investments deliver at the same time, and not all of them perform well at and some of them will hold up in different environments. So, I mean, diversification is often described as the only free lunch in investing, and there's always a trade-off between risk and return, but you can really easily diversify your risk through there.
We've just had a question which I think is quite a good one, and the question is that I've heard that active investing is a better strategy when the market is very uncertain, like now. If this is true, what role would ETFs play during these sorts of times?
Yeah, it's one that comes up a lot. And on the surface, you would think that an active manager picking individual companies and the best ones might be able to outperform through these volatile markets. What you will find is that isn't necessarily true. Some of them may do, but it very much comes down to different active managers have different strategies. And some of them have actually got more concentrated portfolios than an ETF. And if they're less diversified, you might see them suffer more. So there are some growth managers out there at the moment which are seeing bigger falls than the NASDAQ, for instance, with a heavy technology focus. That being said, it's not to say that active managers may have no place in your portfolio whatsoever. It's what we like to talk about is building a robust core, an efficient core, and ETFs can help you do that really well. So having that blended portfolio, and you can see actually an example on the right hand side there, that pie chart, and a blend of Australian equities, international equities, cash, and then some other asset classes. But keeping your costs low and the center of your portfolio diversified, and then maybe thinking about adding some active managers to generate some alpha or some outperformance compared to the market. But unless an active manager is tilting their asset allocation and upweighting to cash or more different asset classes, it's unlikely that compared to a well-diversified portfolio that they will always be able to provide you lower drawdowns in these periods.
And just a question, when we talk about risk, so risk management and reducing risk, are you referring to the standard deviation of returns or volatility, or are you actually referring to the risk of potential loss of capital?
It's a bit of both. So at the moment, and volatility is, you can almost think like a coiled spring. And over the short term, volatility is going to be big swings within your portfolio. over the long term, you sort of stretch out that spring, and volatility becomes less of an impact. So the longer you have, the less of a risk volatility is in itself. And then you think more about the actual risk of total loss. So there are different risks here, and diversification will help with both of them. If you hold 100 companies rather than one, your risk of that company going bankrupt or you losing everything is typically lower than just holding the one. But also, by holding 100 different companies, particularly if they're across different sectors or regions, that's going to lower your overall volatility as well, which is a risk in itself.
And just beyond diversification, if we're looking at our risk and return trade-off, and then, you know, making sure that our portfolio is properly diversified.
Yeah, and this slide, I mean, covers again what I was mentioning with volatility. Volatility goes hand in hand with what you're doing. Stick to your investment plan, and like I mentioned, individual companies may go bust. They may go to zero, but diversifying across it will help reduce that risk. So making sure the sustainability or the longevity of your portfolio is crucially important. And then look at, is your portfolio appropriate for you? The shorter your time frame, like I said, where you are in your life stage, what your financial objectives are, knowing that your portfolio is appropriate for them is going to help you manage through this volatility.
Okay, so that's sort of the fundamentals and what we need to, I guess, just focus on and center, just to keep a cool head during this time. So if we are being a little bit proactive and we're looking ahead at what's next during this period, what are some things to do?
Like I said, stick to the plan. It is a lot easier to stomach these sorts of periods if you have your investment plan firmly in your mind and you know that your portfolio matches your objectives. So just starting on the left of this slide here, think about your portfolio objectives. Why are you investing? Are you approaching retirement? Or, you know, whether you're young and you're saving for your super and you've got a long period of time, or if you're saving for a house deposit. You may be retired and not working, so maybe you look to generate income from your investors, or you're working and you've got a salary and you don't need that income, but you're more interested in growing that pile of assets for the future and growing your wealth. So that then takes you into your investment time horizon. And like I said, and I've repeated many times, the longer you have, typically the more risk you can take, because you've got more time to weather out these drawdowns, because over the long term markets have trended upwards, but these drawdowns can last for a reasonable amount of time and can be quite severe. So the longer you have, the more risk you can take, and your investment objective is going to determine your time horizon. If you're just approaching retirement, for instance, the risk of your portfolio declining or going down by half is a lot higher, because you might not have the time to recover before you start needing to generate income off those assets, compared to someone who's just started out in investing. And therefore that time frame takes you across to your risk tolerance there, which will be impacted by those things mentioned before.
Yeah, absolutely. And I know you said that you know, my suggestion of not to even look wasn't really helpful, but I do think the sort of discipline required not to keep looking at your portfolio on a daily basis and seeing those you know, swings when you do stick with the plan is a lot easier.
Yeah.
So perhaps not looking every day, but sticking with the plan and just making sure you keep in touch frequently.
That's it. Like keep an eye on your portfolio, particularly if you want to make some changes. But the more you look at it, the more time you're going to end up spending on it, and the more stress that can involved, and you might enjoy that. You might see these as opportunities and exciting, but for a lot of people, keeping your eye glued to the value of your portfolio isn't necessarily going to help you there. And it's particularly if you're not experienced in this area or have a high skill set from doing it for a long period of time, sticking to more sort of periodic or systematic ways of adjusting your portfolio can be beneficial.
Yeah, that's really good. And the next points we're going to cover is about rebalancing, and this is really important, especially when valuations and prices are moving around so much. So this is probably something that you want to get across and something to understand, especially at a time like this. Would you agree?
Absolutely. The more disparity you have between different things in your portfolio, the more it's going to shift your asset allocation around, and that typically happens in more volatile periods.
So what, in a very basic sense, what is rebalancing?
So rebalancing would be shifting some of your assets from one area. So over time, say you started with, and I've got an example on the next slide, which I can go through. That's probably an easy way of doing it.
Yeah.
So for instance, you start on the top left of this, and this is an example through the COVID crisis. So that those 3 months where we really saw markets fall dramatically. So starting at the end of 2019, and say this is just a hypothetical portfolio,
yeah,
rather than suggesting that you should have this mix. But say you started with a 50-50 allocation between equities, in this case, just using our A200, Australia A200 ETF, which is shown in orange across this slide, and 50% allocated to a government bond exposure, in this case AGBT, which is shown in grey. So at the end of 2019, you say, I'm a balanced investor. I want a 50-50 split between defensive and growth assets. And then from there, COVID hits and the Australian equity market falls 25% between December and March, so in a 3-month period. But government bonds, being defensive, hold up quite nicely and actually deliver a positive return of 4%. What that does is sees a significant shift as the value of your A200 units go down and the value of your government bond exposure goes up. What was a 50-50 portfolio, you now almost have 60% of your assets in government bonds and only 42 in equities. And what happened from there is actually, coincidentally, we'll call it, but at the end of March, markets rebounded quite significantly. So if you didn't rebalance, you're overweight government bonds when the market's recovering, and therefore would have underperformed compared to sticking to your 50-50 asset allocation. So sticking to a periodic basis, you don't need to rebalance daily or monthly, but maybe on a 3-month, or at least looking on an annual basis and making sure, does my portfolio represent what I wanted it to be when I first set my asset allocation? And rebalancing can really have benefits on your risk-adjusted returns over the long term.
Yeah, definitely controlling your asset allocation and not letting the market sort of take it away from you. So going back on a regular, and I think some of our funds rebalance quarterly, semi-annually and annually. So it just does depend on the ETF, but even the ETFs will rebalance. So
absolutely. So the ETFs themselves will have a rebalancing period within them, and we have diversified ETFs which hold a conservative balanced or balanced growth, high growth ETFs that have a blend of asset classes. Those rebalance on a quarterly basis as well. So rebalancing is an integral part of investing and helps you take that emotion out of it, rather than thinking, oh, my equities have fallen quite a bit, should I buy more equities? If you stick to a rebalancing schedule, you'll automatically do that. And sometimes you'll buy when things are cheap. And other times, you know, they might have further to fall, but it just takes that emotion out of it and means that you're sticking to a portfolio that matches your investment objectives over the long term.
And just to pick up on your point, if I'm going to buy when it's cheap, we've had a few questions about how do we know when it's the bottom or when this current decline is going to swing the other way. And I don't think you can answer that, can you?
I'm not going to pretend I can.
I don't think anyone
no,
can.
I firmly believe there's very few, and people might, and you'll read a lot of commentary out there, and people will be, someone's going to be right, but you look at the track records of people being consistently right every single time. It is incredibly hard to do, and that's why like you may enjoy trying to get it right, but if you are looking to just build an actual robust investment process, sticking to a more scheduled approach and taking that emotion and trying to time it out of it. So whether that's through just a rebalancing process or whether that is through regular contributions over time, that over the long term has tended, and everyone's like objectives and goals are different and circumstances, but over time, generally, sticking to a more long-term and passive approach in that mind has been the beneficial thing.
You spoke about regularly investing, so being diligent or sticking to a plan when you are looking to rebalance. What are some of the benefits of that regular investment approach?
Yes, so there's your rebalancing can occur through two different ways, really. So you could, like, you may be like, so for people who are earning cash, you might be getting a salary that you can invest part of it on a monthly or 3-monthly basis, and you can use those new assets to actually rebalance your portfolio. So buy the things that have fallen more, or through rebalancing, you could sell some of it. You know, in that example previously, you could have sold some AGBT and rebalanced it back into A200. So those are different ways you can invest. You can think about like rebalancing your portfolio, because I think, and we've had a question that come through here, and quite rightly, like, there is sometimes skepticism when, you know, everyone's telling you just buy the dip. Particularly, I mean, BetaShares, you know, we run a portfolio of funds, or your advisor might be saying, you know, buy the dips, or investment commentators just saying buy the dips. And for you as an investor, that might seem easier said than done. You know, do you actually have cash that you can put to work? Are there times where you might be better off selling things? And that is absolutely true. So, like I said before, it doesn't always mean just throwing more cash into the market. Rebalancing can actually mean selling some of the things that have held up well and just tilting your portfolio to buy back some of the others that have fallen a bit to maintain that asset allocation. But yeah, timing the market can be on both sides. It's when you're trying to buy, but also trying to sell out of the markets involves timing.
I think what I like about this chart in particular is that, I mean, it does show quite a long time frame, but no one likes to pay full price. No one, you know, I don't want to buy at the very top. But what it does show that if you are investing regularly, it will average out over time. And, you know, I may be lucky enough to buy at a dip, but, you know, there are going to be times when it's going to be more expensive.
Absolutely. And over the long term, regular contributions to your portfolio will enhance your compounding over time. And you can actually reduce your overall volatility because, like you mentioned, Sarah, you'll sometimes buy when things are cheap and sometimes buy when they're a bit more expensive, but it can average out over time. On the shorter term, particularly in environments like this, you can do a thing, it's known as dollar cost averaging. So rather than throwing everything you have in a lump sum on day one and risking that was poorly timed. Actually spreading that out over, you know, a few days, weeks or months can just reduce that risk of you sort of throwing it in and it all falling from there.
Okay. So I'm just conscious of time. So let's just get to a bit of a summary on where we are. And sometimes the equity market's probably not for the faint-hearted, especially at the moment. And just some things to keep in mind. What would you say are the most important things?
Yeah, I'd say, like, just to summarize some of those points, market corrections happen frequently. Markets don't go up in a straight line. There is that trade-off between risk and return. So make sure that you've got the stomach for where your portfolio is positioned. And keeping that perspective that markets will be volatile. Maintaining a long-term plan with your financial goals in mind can help you make more rational decisions, particularly in times of stress. And then just making sure you've got a well-diversified portfolio that can actually weather the storm and come out the other side.
Mm-hmm. Okay, so what about just some ideas? There's a long way to go in 2022, even if we did have a very fast January. What would you say are some things that investors should look at?
Yeah, we've had this question quite a lot. I mean, most of what we've been talking about sort of centered around what's been going on and how to manage volatility, but people are always interested in a few different ways and different ETFs they can use to implement those views. The first ones I'd say, particularly given the uncertainty around the moment, it can be quite beneficial to be selective with some of your equity allocations. So higher quality companies, so these are companies with strong balance sheets, have historically outperformed in uncertain markets. You often get investors flocking to the companies with strong balance sheets that are more likely to survive through these sorts of environments. In addition, so in order to access quality companies, we've got the BetaShares Global Quality Leaders ETF. These are global qualities. The ticker is QLTY. Then on the technology side, and many of you will be familiar with the NASDAQ 100. There's like I mentioned before, that index has sold off a reasonable amount, and we're going through earnings season at the moment. But the technology companies within the NASDAQ often have high pricing power, and technology companies often have lower labor intensity, so can actually absorb some of these supply side shocks. So technology over the longer term still can remain attractive as we see these shifting demographics as well. In the shorter term, actually, I mean, we've spoken about the inflationary environment and rising rate beneficiaries, some of the ideas. The UK market's a really interesting one at the moment. We've already seen 2 interest rate hikes from the Bank of England, and the FTSE 100's held up remarkably well. And why is this? Well, it's for 2 reasons. First of all, the sector makeup of the UK market. So a big overweight to financial companies, the sort of more energy and materials type companies. And those sectors tend to hold up, actually benefit compared to others in a rising rate environment. Also, the UK has been extremely cheap. They were hit very hard through COVID. We had Brexit come through, so valuations were a lot lower compared to, say, the US market. And therefore, the UK market stayed flat when other markets have fallen dramatically, despite them being the first to raise rates and having a lot of actually high inflation. So you can access the UK market directly through our FTSE 100 ETF F100, but you can also take some of those lessons from the UK market and shift those across to other parts of your portfolio. The simplest one for your US equities would be to actually incorporate an equal weight ETF. So S&P 500 equal weight, rather than allocating more money to the biggest companies and less to the smaller, this holds an equal amount in all 500 of those companies. And by doing that, you inherently underweight the technology stocks that are in there, and you'll upweight some of the smaller sectors which have become underrepresented. So energy companies, financials, and that can give you a much more balanced portfolio, because the US equity market is very concentrated towards those FANG stocks, those growth parts of the market, and therefore has suffered more through this rising rate period. So this is a really simple way for you to just readjust your US equities exposure and make it a bit more favorable for the current environment.
Yeah.
Or if you want to be a bit more hands-on, using some of those sector funds. So energy companies, oil prices have been doing extremely well recently, and global energy companies have held up well. If you think of inflation and what drives it, commodity prices, oil prices, soft commodities like food, so our global agriculture ETF has done extremely well through this environment. And then financial companies, so banks, as interest rates rise, that's actually beneficial for these banks. So there's some of the technical trades or tactical tilts you can make in your portfolio for the next 12 months and beyond, if you were just looking to adjust it.
Yeah, a little bit more timely. And so what about those longer term thematics that I think you spoke about at the start?
Yeah, the other way you can is actually look beyond shorter term market cycles and start thinking about a few thematic investments. And these are probably more similar to when I was mentioning, say, active managers and things. These are a bit more concentrated in their portfolios, so it can be good ones to just allocate as smaller parts of your portfolio, looking to get outperformance over the long term. And thematic investing looks to go for long term, multi-decade, demographic and technological shifts. So things like robotics and artificial intelligence, cybersecurity, which is becoming more and more crucial over time, electric vehicles and future mobilities, the future of payments. We've got things like new ones that have just been launched, such as esports and gaming, as well as e-commerce, and thinking the future of retail. We have the widest suite of thematic ETFs in Australia. The best thing to do, you'll see all of them on our website. They all do that. We have a broad range, and you can explore each of these in your own time after the webinar, but there's some quite interesting ones.
Yeah, and just, I know, hugely popular. We do send, or we have a lot of content and material about these trends and about these funds. In iBuy, which is our e-commerce one, launched recently, and a suite of long-term thematics that are coming this year. So definitely keep your eye on the website, and there's some information there. So and I do appreciate that we have gone over time, but I do, just before we get to questions, I do need to remind you about that investment risk. And I think we've talked nothing except market risk, investment risk today. There's definitely market risk with equities, and also interest rate and credit risk with bonds and cash. So no one is completely safe. Everything is general information only. We haven't taken into account anyone's personal individual circumstances, and you should seek financial advice if you do want to make a financial decision. No guarantees. Past performance does not indicate future performance. Fund PDS and TMDs are available from our website. So it's all really, really important to do your research when you are making those investment decisions. I do want to highlight an upcoming webinar, our very first for 2022, and our most popular series will be our quarterly economic outlook with our chief economist, David Vassanese. And David has told me that he'll be updating and making his predictions on the key indicators during that session. So that is definitely one to tune into to see where he thinks the market is going in 2022. So there will be a link to register for that upcoming webinar next week, Thursday the 17th. and that kicks off at 11 a.m. And it will be CPD accredited for financial professionals. I do also draw your attention to Off the Chain, which is our new weekly crypto insights and highlights email. You can subscribe to Bassinis Bites, our insights, our weekly insights newsletter, or Off the Chain by just updating your preferences on your email. So definitely a lot of information, insight, and education coming from BetaShares as always. So we've probably got time for just a couple of questions. I know this one has come through in quite a few forms, Alistair, so I just want to touch on it. And please be reminded that a copy of the session slides and recording will be sent to everyone this afternoon. So if you want to go back to any point, if you've got any other questions, feel free to drop them through on the info line. But this question has come through, and I'll just use this one. But notwithstanding the building inflationary pressures and negative real rates, gold hasn't moved much, and gold stocks have also been hammered. No, that's the technical term. What is going on with gold?
Yeah, gold's an interesting one. It's often seen as an inflation hedge. You're right, we had loads of questions coming in around gold because the typical rhetoric is, you know, buy gold for inflation. However, in an environment like we're seeing at the moment, where inflation's mainly been driven from the supply side and you know, labor shortages, actually other commodities which are, you know, things like energy can actually benefit more, and that's exactly what we've seen playing out. Gold tends to be a better hedge for a devaluing of a currency, like so the debasement of, say, the US dollar. But that being said, like over the long term, gold can act as a safe haven. It can provide portfolio diversification for you. It tends to be uncorrelated, particularly gold as a commodity, physical gold, as opposed to the equities, can have benefits in portfolios. But yeah, I'd say it's a better protection for a falling US dollar. It's for that exact reason that we've our gold exposure is currency hedged as well, because it often does well when the US dollar is falling. So yeah, at the moment, for this sort of inflation, other things such as oil and soft commodities are potentially a better inflation hedge, and that's what we've seen.
And just a quick one on blending investments. And we spoke about building robust portfolios and diversification. So as BetaShares has a number of ETFs, we have 67, would you recommend diversifying across different ETFs and not just one ETF?
Yeah, so we've got a vast range, like Sarah mentioned, 67, I believe, and some of them are a lot more concentrated than others. So it's probably beneficial to build a really robust portfolio. Using a blend of ETFs is probably the sensible thing, like I mentioned, to get exposure, not just to Australian equities, but you know, having some international in there, having different sectors and regions. That being said, if you are starting out or looking for the most efficient way to build a portfolio, we do have a range of diversified ETFs that do this for you. The BetaShares All Growth ETF holds like 5 or so ETFs across different asset classes, all in equities focused, but can give you that instant diversification in one simple trade, not only across a wide range of companies, but different sectors, regions, and ETFs in themselves. So that is the single most efficient way you could get a robust portfolio.
And I mean, the ticker there is DHHF, but you also mentioned that they rebalance.
Yeah, they rebalance. That rebalances on a quarterly basis as well. So you get that rebalancing. Then we have a range of ethical diversified ones, but the key when you're choosing how many ETFs, make sure they're differentiated from one another. Look, the holdings are transparent, so you can make sure that you're not holding two for the sake of it instead of when one would do. So look what's underneath and in your actual fund.
Thank you. Thanks, Alistair. Thank you, everyone, for joining today. We've had an awesome turnout for the first session back. We got there in the end after those early technical difficulties. I hope you've been able to hear us okay. Thank you very much, and thanks, Alistair.
Thank you. Thanks, Sarah, and thanks everyone for joining. See you next time.
And we will see you next time.